Hello guys, in this video we are going to discuss about accounting and finance for bankers unit 1. Everyone thinks that accounting is an toughest paper, but actually it's not. It's interesting as reading a storybook. Our YouTube channel support you to make it more interesting to learn accounting. So the latest edition so far is 4th edition. If anyone is using old edition, kindly buy the new one. So many things has been updated. If anyone not yet subscribed our YouTube channel, kindly subscribe, bookmark. In accounts, there are totally 4 modules. We can't be able to say this module is important or that module is important for exam point of view, because every unit is very important. It's used in banking and various fields, so we can't be able to say this one is important. Everything is important. In our YouTube channel we are going to discuss each and every unit in a detailed manner. First unit is calculation of interest and annuity. So from childhood we are somewhat familiar with interest, so it will be quite easy to understand, but annuity is a new topic, but don't worry, we can make it very simple. So the objective of this unit is to understand the mathematical calculation of simple interest, compound interest, annuity and sinking fund. Okay, introduction. In introduction they give an overline of an unit 1. Generally, bank accept deposit and lend money. So in both aspects, we have to pay some interest or receive interest. In order, the interest has been classified into 2 categories. One is simple interest, another one is compound interest. Simple interest means for a period, interest is received only once. So it's very simple. So it's a simple interest. The formula for calculating simple interest is interest equal to principal into rate into time. Principal means the amount that have been lent or borrowed. The rate is what percentage the returns or rate of interest is given or received. For example, if 15% is a rate of interest, then 15 divided by 100 equal to 0.15. We are going to use like this only in sums. In childhood, we have used a common denominator as 100. For calculation purpose, to make it simple, we are using like this. And then time, for how much period, for 1 year, 2 year, for how much period we borrowed or lent, it's time. Illustration. For an example, a student purchases a computer, okay, by obtaining a simple interest. The computer cost is around 60,000 and interest on loan is 12%. He repays back after 2 years. The formula I equal to P into R into T. So principal is equal to 60,000. That interest is, the rate of interest is 12%. So 0.12 into 2. What we get is 14,400. So the interest alone we will get 14,400 you have to pay. So total amount what you are going to pay is principal plus interest. So principal 60,000 plus interest 14,000. So overall amount you are going to pay is 74,400. Okay. From this we can able to understand that it's a small notation. So for this one I equal to P into R into T, and then the total amount paid back is denoted as A equal to principal plus interest P plus I. That in for this I we substitute this one here. So it will be like this, and then A equal to P into bracket of 1 plus RT close bracket. Here if we ask to find interest but we know the maturity amount and principal amount, then we can able to find the interest. So overall these kind of simplification we are going to use. So one more illustration they gave, it's quite similar to the previous one. So Morgan invested 5,000 in a company, fixed deposit 9.8% per annum, and then 2 years. So we are going to get 980 as an interest for 2 years. This formula we are going to use some places. They may ask how much they are going to pay along with the principal. So that kind of problem we are going to discuss now. Here, short-term deposit account open for 180 days with an interest of 5.3% in a bank. Okay, 50,000 you are going to deposit. How much money will have after 180 days? He blindly asked how much money, so we have to put together principal and interest. Then only we can able to say. So for this we are going to use this one, A equal to P into 1 plus RT, total amount, how much they are going to get. By solving that, we may get 51,307. For some cases we are going to use this like this. So next we are going to see about compound interest. Compound interest will get in more profit when compared to simple interest. The main reason is that frequency. For interest also will get an interest. For example, 10 years we are lending means first year we get some interest. For that interest also second year interest will be applied, so we will get in more amount. Here for illustration some notation has been given. As usual, P rate of interest, N means number of years, A is total amount, how much money you are going to pay. So this is a compound interest formula. That in previous simple interest, that time period will be inside the bracket, but in this case the time period N number of years will be power. So it's a difference between simple interest and compound interest. For example, if we borrow for 5 years, then N will become 5. But one more important point to be considered is the frequency. The more number of frequency will get N more number of profit or interest. For example, annually means 1 plus or this formula, but quarterly means 4 quarter. So for R divided by 4 whole power 4. If monthly means we have to divide by 12 and power 2. By put together, the final formula for compound interest is A equal to P into bracket of 1 plus R by N close bracket power N into T. N means number of years, N is number of times per year interest is compounded, T means number of years. So far we are saying that the more frequency happen, more interest we will get. Like that I said some more times. So to make it clear, they given a table 1.1 about that. So for example, if principal is 10,000 and rate of return is 6% for yearly compounding frequency, if it is, then it will be 10,600. Semi-annually means 10,609. Quarterly 10,613. It's keep on increasing. In book they just given table. I have worked out for semi-annually and quarterly. This one is for annually. In case of semi-annually, as I said, divide by 2, because semi-annually 2 times, so power also 2. If we solve these things, we'll get 10,609. In case of quarterly, we divide by 4 and then make it power 4. Then we get 10,613. From this table, we are clear. The more frequency interest is taken, the more interest we give frequency. Okay, they give a special note. If we keep on compounding, what will happen? For that purpose, they given formula A equal to P exponential RT. This is approximately E is approximately equal to 2.718. They given, but in actual case, it not going to happen. But for example, they give one more main important rule is rule 72. It's very important because we use this rule 72 in practical life also, in banking also. For example, one person asking what's the rate of interest. If I deposit 1 lakh, in how many days or how many months it will double. they may ask, we make it how to calculate, we may think like that. For that, this rule will be very helpful. For example, you borrow 1000 rupees at 6%, then 72 divided by 6 is 12. That 6% should be in denominator. 72 divided by 6, it should be divided by 6. Then we get an answer 12. Then means in 12 layers it will be get doubled. You see, 72 is a rule, so it's constant, and then divided by rate of interest, it's 6%, so amount will be doubled in 12 years. In compound interest, they given 3 examples, so we are going to see first illustration. In first illustration, they said simple interest in 3 years and compound interest in 2 years and certain sum. Certain sum means both having same principal amount at same rate. Rate of interest also same. They gave as simple interest. After 3 years, you will get 1200. In case of compound interest, 832 respectively. Then the question is, what is rate of interest? What is principal? What's difference between compound interest and simple interest in 3 years? Okay. So to make it simple, I solved in paper. In case of simple interest, P into R into T equal to interest. Here they gave an interest 1200, so 1200 P into R 3 years, so T they given 3 divided by 100. By simplifying this, PR we get 40,000. I keeping a notation P equal to 40,000 by R. I will explain why I made like this in later. In case of compound interest, so generally compound interest formula is A equal to P into 1 plus R all power n. A means nothing but principal plus interest, so we don't know principal, so let me notate as P plus interest. We know 832 equal to P into a rate of interest divided by 100, so using 100. Now I am taking this P this side, and then I am taking this numerator and denominator separating from this square. So while solving this, I cancel P, so 1 plus 832 by P equal to, you will get like this. Then later I am taking this 100 square here, so I need to multiply for both 1 also and for this term also. That equation becomes like this. Here P, we already find out P in simple interest, so we are substituting that thing in denominator, so it becomes like this. We may have a question in how can we use that value here, because they said like that principal and interest is same for both simple interest and compound interest. Okay, and then while solving this, I cancel this 40,000 and this 100 square I wrote as 10,000. I cancel this 4 will be cancelling 832 208. Then 100 square plus R square. This one I using formula A square plus B square plus 2AB. By solving this and cancelling 100 square, that final value will be R square plus 200 R minus 208 R equal to 0. Then R square minus 8 R equal to 0. By using quadratic equation, we get R equal to 0, else R equal to 8. Obviously R cannot be 0, because for 0 rate of interest no one going to offer a loan. So ultimately R will be 8%. By substituting this 8 in here, we get principal 5,000. So far we find out rate of interest and principal, and one more thing we have to find, that is difference between compound interest and simple interest for 3 years. So already for simple interest they said 3 years only they given, so now we have to find only for the compound interest. For finding compound interest, by using a formula, we are going to get this amount. So only only if it's a compound interest for 3 years means this much we are going to get. So we have in both 3 years for simple interest and compound interest. By taking difference, we can find its answer is 98.56. Next illustration. The population of an industrial town increases by 5% every year. Now present population is 1 million. They are asking a question, two questions. After 5 years, how much will be population? And then before 3 years, how much was the population? It's same as the compound formula. 5% annually. By using same formula, P into 1 plus R power T, which is 1 million, 1 plus R raises by 5%. 5% means 5 by 100, then 0.05 for 5 years, T5. By solving, we will get 1276280, and they asked a population 3 years ago. How much was the population before 3 years? For that, we are going to use formula like this. Why are we going to use like this? Means for compound interest, this we are using for compounding. So if I are going in reverse, means this part should be in denominator. So by solving this, we will get 863838. Okay. And one more example is, a machine is purchased for 20,000. For example, 20,000. It depreciates every year 10%. They are asking how much find the depreciation value of machine after 3 years. Also find amount of depreciation. What is the average rate of depreciation? They are asking average rate. Okay. Original value is 20,000. Rate of depreciation is 10%. Here they gave there like that. Book value after 3 years. Book value means every year 10% is going to depreciate. It means only 90% of actual amount of the machine it would stand. So 20,000 1 minus 0.1 whole power 3 is 0.9%. Each and every year 10% will be lost. Only 90% will be standing. So to make it simple, we are solving problem like this. 20,000 into 0.9 whole power 3, we get 14,580. After 5 years, book value of the machine is 14,580. They are asking amount of depreciation in 3 years. By minusing 20,000, we get 5,420 as an depreciation amount. And then the last one is average rate of depreciation. They are asking flat. For 3 years, how much it has been depreciated? 5,420. Divided by 20,000 into 100 divided by 3 for 3 years. So we are going to get 9.033%. In case of flat depreciation means for example, they given this, we are going to study detail about depreciation in unit 3. There are numerous methods are there to calculate depreciation. While seeing unit 4, you will get an absolute clearance in this topic. So far we have discussed simple interest and compound interest. Next video we are going to see about annuity. Annuity is the most important topic not only in this unit. This topic is going to be used overall accountancy also. Thank you for watching video. If anyone not yet subscribed, kindly subscribe our channel, bookmark.